give us your opinion. I'm sure all your clients are emailing you, calling, asking the same question. Is this a real pause or is it a pit stop? And do you see a hike coming later this year?
Yeah, so I think it is a real pause. I know people like to call it a skip, which would imply that it's just very brief. But if you think about this through the lens of a policymaker, if the data in hand suggests you should pause at this meeting, then with one more round of data before the next meeting, what can be so different about that data that suggests you come off that pause? So I still believe today the markets are overpricing the probability that this is just a very temporary pause and then they hike again at the very next meeting. Now, I think you should have some sort of risk priced in that they could resume hiking or deliver another hike at some point this year. But based on my forecast, which I have to base my Fed call on my forecast, inflation is going to continue to recede, although stay high. Wages receding, but staying high. Unemployment remaining low. Job gains remaining resilient, right? Everything moving in the right direction. And so I think the Fed stays on a tightening bias, but I think that means that they hold rates high for longer.
So that sounds like a soft landing. I mean, it was a long explanation. It sounded like we were heading towards a soft landing in your mind. So we're seeing a pretty strong rally. The S&P at a 52-week high. We're seeing the NASDAQ continue to gain. How much of this do you think is, you mentioned risk needs to be priced in, but traders not only pricing in a pause, but maybe even a cut?
Yeah, so I think that they don't need to cut until 2024. If you think about, from an economist's perspective, uncertainty bands around your forecast, and the Fed has really wide uncertainty bands right now, especially with all the credit tightening and their prior policy moves, then it's not unthinkable that they might have to cut earlier. The question really is, why are they cutting? Are they cutting because there's economic disaster, which would mean sharp cuts, very front-loaded and quick? Are they cutting because inflation is moving along the path that they desire and it's time to start normalizing policy? I'm in the soft landing camp, normalizing policy, but I think a lot of the market is pricing in that the Fed will be cutting earlier than that because the economy is not going to look great.
All right, so I want to be clear. So you're saying they would cut before they get to 2% inflation because of other macro factors in the economy? Yeah,
because you've got trend inflation that will be coming down against a backdrop of an economy that's been growing very slowly below its potential, and in job gains that are slowing. And so if that's the case, you don't need to hold rates high for that long, right? You still need to hold them high while inflation is still high, but everything's moving in the right direction. I think that when trend inflation is dropping below 2.5% and looks like it's core inflation and still moving lower, then that's the time that you can start to normalize policy. So essentially, in economic terms, right, neutral rates are falling, and you're just chasing those neutral rates lower.
All right. So before the July meeting, we have two big things coming up. We got PCE, the Fed's preferred inflation gauge. We're using CPI, or saw CPI yesterday, and we also have a jobs report. So just for all the investors out there, they're hanging on your every word. I know your phone's ringing off the hook. What do we need to see from those two things to keep us on this pause path?
Yeah. So PCE is going to feel like old news because when we got CPI yesterday and we get PPI later today, that gives you all you need to know what core PCE is going to look like. And so the Fed's already going to be looking past that because they get, like you said, another jobs print and the CPI print before the July meeting. And so jobs, I think 250,000 plus keeps July on the table from a market pricing perspective. I don't think it gets the Fed there. And I think that it's going to have to take something like that core CPI, excluding rent, excluding housing, excluding medical prices, which is Powell's preferred measure right now, say a 0.7. I mean, it's a really high bar. It has to reverse the slowing trend that we've seen in inflation. So I put the bar very high to a July hike.
Is there any other report we should look at or anything else we should look at? I know a lot of people are concerned about the banking situation and maybe that could influence the Fed, but that really has seemed to kind of ease and just normalize.
Yeah, so credit conditions are tightening, lending standards are tightening. We're going to continue to see that. I think what's important is that demand for loans is also falling at the same time. And so this looks like a normal downturn in the credit cycle. This is not a credit crunch where credit just chokes off to the economy. So certainly something like that is going to matter in terms of, is the Fed even comfortable staying on pause? Would they need to cut for some reason?